I started my career in 1998, 99. My first experience in the equity markets as a trader was going through the 2000 to 2003 dot-com bubble crash. I was there for the great financial crisis in 2007 through 2009. I was there for the COVID crash, and we're here now. This is a scenario where we have to look at what causes these market events and what do we need to know. So what I want to do is I want to go back and look at the charts and see what each one of these bull markets and subsequent market crashes look like. So going back to the 1999 2000 bubble, the one thing that is evident in almost all of these is the fact that the market has an extended bull run. These extended bull runs create euphoria, retail excitement, easy money, ridiculous valuations, huge amounts of leverage, and makes a large amount of investors positioned all in one way at a time when the conditions are changing. You can observe here right before that market crash of 2008, a similar style rise occurred where the bull market proceeded higher. The same euphoria was coming in, and then it turned. We'll talk about these five conditions in a moment, but whether you look at the COVID crash right over here, which had this extraordinary bull run before the COVID crash, and or the period right before the 2022 bear market, you have a scenario where markets extend higher this way. So let's talk about these warnings and what they are. Number one, tight monetary conditions. So when looking at this chart here, I have the effective federal funds rate, which is controlled by the Federal Reserve. And what you see is that prior to each one of the market crashes was a period where they tightened monetary policy, which is they raised interest rates, making credit hard to access and expensive to access, dropping liquidity and money supply growth. Each one of these scenarios leads to a tightening of conditions, which basically bursts the bubble and ultimately creates that distribution cycle. Number two, the stresses in the credit markets. So, like we just talked about, the Fed raises interest rates, tightening monetary conditions. Now, what does that mean? What's a good analogy of explaining where these stresses in credit markets come from? Well, imagine a bathtub that has got the tap running and water is filling the bathtub level. That is a Fed providing liquidity into a marketplace to keep the water level high in the bathtub. Now imagine that bathtub plug is always pulled. Now, when the Fed tightens conditions, it essentially shuts off the faucet, and therefore the water level starts to drain. Inevitably, when there's less money and credit available in the system, there's less to go around to keep these asset bubbles going. And ultimately, it's trying to let some air out of the balloon, to use another analogy. So, what ends up happening is there's things start to break. Some of those things that were over leveraged in the credit markets start to show problems. In the case of 2007, 2008, it was in the subprime mortgage market. But in all crises, there's something that emerges that is a byproduct of the fact that the credit markets start to get under stress, and then it starts to disseminate into the rest of the markets. The one thing that almost always occurs when credit stresses emerge is that central banks therefore rush to provide liquidity, and the mechanism they do is, whether quantitative easing and or providing liquidity, they turn around and start to drop interest rates. What you can observe here is, for instance, in 2007, when the first signs of the stresses in the markets emerged, interest rates started to decline, and observed that through the entire bear market decline that lasted all the way to 2008, interest rates kept getting lower and lower in this period. This is always a byproduct of credit stresses, and we're looking to see if those kind of signs are emerging today. Number three, excessive leverage builds and retail euphoria peaks. This is critical. because what makes a market crash is that investors are positioned incorrectly, and there's going to be a lot of people that are going to be wrong. It creates a bottleneck. The way I describe it is it's like yelling fire in a nightclub with only one exit. People get trampled. You can't have a market downturn that doesn't first have the backdrop of everyone being positioned into a consensus view that just isn't so. And often this leads to very rich, if not even outright ridiculous valuations given on securities, and it leads to margining and leverage. Now, investor greed is actually an important component because as investors are making money, their willingness to risk some of the money made by leveraging is a way for them to compound their gains and try to get the maximum amount out of this. And so what ends up happening is they end up borrowing large sums of money or leveraging through options or other futures and other derivatives, and ultimately that worsens their situation to be able to hold through a market correction, because margin is a double-edged sword, which is on the way up it makes you a lot of money, but on the way down it can cause margin calls and or liquidation of all of your assets, and therefore investors are forced to sell and to panic out of their positions when they're all wrong. So you have to see the backdrop of a condition where things are ridiculously priced. All investors are euphorically invested into a great idea, and ultimately you have a situation where the market then turns around and makes a lot of people wrong all at the same time. Number four is a key component, which is smart money is selling. It creates distribution. Now, what you have is a market where a whole bunch of retail investors are euphorically buying with these great ambitions of making all sorts of money in the markets. And the smart money at some point starts and is more than willing to sell them the stock they want. This is why we have periods known as topping formations, extended periods where the market stays at elevated levels but stops making progress to the upside. So, looking at this chart, we have the chart of the 1999 to 2000 period. Now, while we had a couple of dot-com stocks ripping and the Nasdaq ripping, what you can observe is that the majority of the S&P 500 was actually spending over a year struggling to make new highs. There was essentially, well, retail investors were so excited about everything and buying anything and everything that they can get their hands on. The smart money was more than happy raising cash and selling that stock out there. You will often see huge insider selling amongst companies where all the CEOs and other executives are actually selling stock up along their highs, including very prominent investment funds and hedge funds raising cash. Just to look at another example, let's go back to 2007, prior to the great financial crisis. And we had that extraordinary bull run. And then starting in early 2007, when subprime started to crack, you had a market that spent almost an entire year just trading up along its highs. There was lots of bullishness in the market, lots of people buying, but the smart money was selling, and the retail investors, seeing that there's nothing wrong with the market, continued to believe the story and get all the excitement about all the money and potential to be made, but yet the market is not making any progress in that environment. Number five, the exogenous changes in political or geopolitical conditions. You have an environment where investors were used to everything being clear, everything being in place in existing administration, and suddenly new variables are introduced that confuse or muddy up the waters, giving no clarity as to whether or not their existing investment themes can actually continue to play out as they envisioned. So, what does an investor do when they start to see these warning signs? Number one, don't panic sell. Position strategically. This is key because if you panic sell and raise cash and go and bunker down, often you're going to feel a huge emotional stress if the market isn't immediately downturning. If the market, let's say on a short window of time, continues to rise, the FOMO, the fear of missing out, often succumbs that investor to rush back into the markets at the worst possible time. The second thing is if you're in cash and the market event isn't happening, then you become frustrated that things are not happening that way. You want to try to remove as much of that stress of making this a binary decision of all in or all out. The second thing is you reduce your leverage, raise some cash, and increase holdings of uncorrelated assets. What you want to think is that market crashes tend to be occurring in those things like we talked about that investors over own, and where you need to have almost all retail investors crowded into a trade, and then that yelling fire in a nightclub event kind of occurring. So when you diversify into some uncorrelated assets, reduce the margin leverage or any leverage that you have, and even raise cash so that you can actually buy things if there is this decline, allows you to feel that you're in a really good position to deal with it. Number three is consider hedging. Now, this is new to many investors, but using options as a way to actually buy insurance on the downside of your portfolio is a fantastic way of managing risk. Why? Let's say you have a portfolio of high dividend paying stocks and you're relying on that income stream, or you are invested into you know 30, 40, 50 positions. The idea of liquidating everything in your portfolio becomes a big task. And what you want to consider is that by buying portfolio insurance on the downside, it allows you to remove the risk of a big drawdown in your portfolio if there was a market event. And more importantly, when a market crash does occur, that insurance pays out as cash when you're selling your options. That allows you to use that money to actually dollar cost or buy new positioning in the portfolio. Now, a perfect example of that hedging is where we have a portfolio called our cash flow compounder, where we hold high dividend paying stocks and other investments that are earning cash flow through things like option writing. Now, we had a portfolio insurance built in there. Now, when we look here, we just had this first wave of a market crash that occurred in March and April of 2025. And when that market started this decline, that portfolio insurance not only mitigated all the losses in the portfolio, but at the market bottom, when we cashed in that insurance, we were able to reposition on so many of our positions and turn them all into profits when the market bounced. These types of hedging strategies is something we do real time at Big Picture Trading. So those of you that want to learn more about that, make sure you visit our bigpicturetrading.com website. So it is May 2025. What's flashing right now? Well, number one, we have a Fed that is maintaining very tight credit conditions. So looking at this chart, I have here the effective federal funds rate by the Federal Reserve. And so we had one of the largest monetary tightening cycles in history that occurred in 2022 when they raised interest rates to over 5%. Now we are seeing that the Fed is attempting to start to ease, or did attempt to start to ease, but since then has started to flatten and maintain the existing interest rate on concerns of the inflation rates being sticky and other variables of lack of clarity for the existing political administration. The point here is that the Fed, are they making a policy error? Should they be easing more and not allowing the economy to continue to contract from the high interest rates? So we now know that the Fed is keeping conditions tight, but now are there credit stresses in the markets? Well, one, we have the US fiscal imbalances continuing to worsen. We have yields near record highs, and cracks are emerging in the bond market plumbing, currently known as the basis trade. Now, with this, we also have credit spreads widening. All of these are symptomatic of conditions that are too tight, and these things are all risk points that could at some point crack and actually create a feedback mechanism. This is really important because the bond markets are much more important than the stock markets, and the reaction function by central banks will be there when the bond markets run into trouble. And so, are we seeing that these issues right here are going to become worse in the weeks and months to come? Is one of the puzzles to solve. Now, in regards to excessive leverage and retail euphoria, we have to go back to the start of the year. Now, saw a period where US equities were the darling of the world. The Mag 7 stocks, which is the Apples, Amazons, and Metas of the world, were all ripping higher to the point that they became extraordinarily large relative to all the other parts of indices. It was a scenario where retail investors, that was the only thing to own, the only place to be invested. And so we had this area where all investors around the world were crowded there. This led to TINA, which is there is no alternative. When you looked around the world, there were very few equity markets that were actually working outside of that. So this was not just US retail investors, but investors and institutions around the world all flooding to chase US assets. This created that crowding that has now already seen the first wave of selling, where we saw many of these Mag 7 stocks lose up to 30% of their value during the most recent decline. To illustrate this, here we have the Mag 7 ETF. And essentially, in just 1 year, throughout 2024 to 2025, we saw over 100% increase in these stocks in just 1 year. That really showed that euphoria and that leverage pouring in there. We saw since the start of the year this market correction that saw over a 30% decline in these securities. And then the question now is that, was this just the beginning? Often, bear markets can last 6 months to 2 years in length. And this was just a 1 month start to the market correction. Was that the peak euphoria? And will the selling continue? Is the puzzle to solve. To accompany that retail euphoria, 2024 saw some of the highest levels of insider selling that we've seen in a decade. And so, what we had was the scenario where all the euphoria was there by retail investors, while the insiders were recognizing that euphoria and using those higher prices as an opportunity to do some much needed profit taking. And of course, today we have substantial political and geopolitical tensions, with the tariffs causing stresses around the world, and trading partners having disruptions. We have a lack of business clarity. In many businesses are holding off on capex spending and hiring until they see how the results of all of these trade negotiations actually play out. In these conditions, many of these companies are tightening their belts, spending less, which can obviously have knock on effects that actually slows the economy towards a recession. All of the things we talked about are the warning signs that often come before bear markets or major downturns of this market. Now, many of you that are watching this video are watching it because you're curious about how these things play out and want to learn more. If you want to see how we manage through these types of cycles, just click on the links below to learn more about us. Thanks for watching.